Welcome to CPA Australia's webinar, Independence Requirements Are Changing, What You Need to Know. My name is Siobhan and I will be hosting this webinar and available for any troubleshooting questions you may have with your WebEx setup. We have people joining us from all over the country for today's webinar. I would like to take a moment to acknowledge the traditional owners from around Australia and pay my respects to elders past, present and emerging. I extend this acknowledgement to all Aboriginal and Torres Strait Islander people who may be joining us today. Also joining us today is Claire Grayson, Policy Advisor, Audit and Assurance from CPA Australia, who will be helping with Q&A at the end of the session. And now I would like to introduce you to today's Chair, Josephine Haste, who will facilitate the session. Josephine, I will open your mic and camera. Hi, Josephine.
Hello, Siobhan.
Excellent, we can hear you, so over to you.
Thank you, Siobhan, and welcome everybody. I am the Policy Advisor for Ethics and Professional Standards at CPA Australia, and today it's my pleasure to introduce to you our panel, Channa Wijesingh, Doug Niven and Kelly Grant. Channa Wijesingh is the Chief Executive Officer at the Accounting Professional and Ethical Standards Board. Channa has been with the APESB for 13 years and manages the implementation of the board's strategy, national and international stakeholder engagement, operations and technical work program. He functions as the chair of the board's task forces and has overseen the issue of the APESB suite of 21 pronouncements for the Australian accounting profession. Channa also represents the APESB at the IESBA National Standard Setters Group. Welcome, Channa. Secondly, I'd like to introduce Doug Niven. Doug is the Chief Accountant at the Australian Securities and Investment Commission. Doug is responsible for ASIC strategy and policy on financial reporting and audit matters, complex and contentious accounting issues, and advising other ASIC teams. He is a member of IOSCO's Committee on Accounting, Audit and Disclosure, and a member of the International Forum of Independent Audit Regulators. Doug has been with ASIC for 22 years and was previously with a large audit firm for 15 years. Welcome, Doug. And finally, I'd like to introduce Kelly Grant. Kelly is the Director of SMSF Auditors Portfolio at the Australian Taxation Office. Kelly has been with the ATO since 1997. Kelly worked in a number of areas before joining Super in 2008. She spent several years in Super's complex technical unit, providing advice on a wide range of issues, and has also worked in the SMSF area. Here she spent some time in the trustees' portfolio determining the appropriate responses to and treatments for a range of SMSF income tax and regulatory risks, as well as managing the early engagement and voluntary disclosure service that trustees and or their advisors can use to rectify fund breaches. Currently, Kelly is working in the approved auditors portfolio and is involved in identifying and treating risks associated with the sector, as well as creating strategies and guidance to assist auditors with their regulatory obligations. A very warm welcome to you, Kelly. Today we'll be taking questions through our Q&A box. Please direct all questions to all panellists. We will address questions at the conclusion and we'll do our very best with the time remaining to address all questions. For any other questions, though, that aren't addressed during this process, we'll endeavour to address them via the script. For any troubleshooting queries, please send a message to the host using the chat box. It is now time for our session to commence, so I'll hand over to our first presenter, Channa Wijesingh.
Thanks, Jo. Thanks for the introduction. Good afternoon, everyone. And thank you to CPA Australia for this opportunity to talk about the standard setting environment, the restructured code and the independence guide. So every decade or so, we have a financial crisis, and then there's intervention from legislators, regulators, and other stakeholders. The origins for the major changes of the code in terms of the restructure of the code, audit partner rotation, non-compliance with laws and regulations, or NOCLA, can all be traced back to global stakeholder concerns raised post the GFC, which now seems a lifetime away. In Australia, the restructured code was issued nearly 2 years ago on the 2nd of November 2018 with an effective date of 1st January 2020. This is the most comprehensive rewrite of the code that has occurred in the last 2 decades. There's a new user guide on how to apply the code. There's a revised glossary with additional explanations of key terms. Requirements are now separate to guidance material, which means that it will be easier to implement by accountants, but also for enforcement action by regulators. There have been significant refinements to enhance the conceptual framework, which now makes it explicit that in certain circumstances, you need to disengage or stop that activity. The auditor independence provisions have been recharacterized as independent standards, and it also incorporates the audit partner rotation and the no-CLAR provisions in the new drafting format. The code is principles-based and sets out a conceptual framework to assist with the application of the fundamental principles. While the conceptual framework has been enhanced, the core of the codes, the 5 fundamental principles, such as integrity and objectivity, and the 5 threads, some examples are self-interest and self-review, those remain unchanged. The overarching requirement for all members to apply the conceptual framework to comply with the fundamental principles is explained in detail in section 120 of the code. Section 120 has also now been referred to at the beginning of each section of the code. This is to clearly recognize the role of the conceptual framework in the code, and there's now clear recognition, as I said, that in some cases there are no safeguards and therefore you need to stop the activity. It is critically important to understand how the conceptual framework works as it flows through the whole code, and it is the foundation. There are 3 main stages to the application of the framework. As you can see in this diagram, you need to identify threats, then you need to evaluate threats, and then you need to address those threats. And then flowing right across the whole process is that in all stages you must exercise professional judgment, remain alert for new information and changes in facts and circumstances, and use the reasonably informed third-party tests. So some examples of reasonable and informed third party could be a senior finance person, a board member, or even a regulator. The auditing standard ASA 102 on relevant ethical requirements provides legal backing for the code in respect of Corporations Act audits. Additionally, FIS legislation and regulations also refer to APES 110. Accordingly, it's critical for auditors to be on top of these changes, given the code is now effective, and as its requirements are explicit, this also facilitates monitoring and enforcement by the regulatory bodies such as ASIC and ATO, as well as, in some cases, the professional bodies such as CPA Australia. I'll also touch on some international standard setting activities. Members must be aware of these because over the next 12 to 18 months, these requirements may be incorporated in the code as well. So some of these relate to fees, non-assurance services, and there's a project that is not on these slides, which is about the definition of public interest entity. I have not put the PI project on the slide, as in Australia, we have had a comprehensive definition of PI. I just saw a message, maybe somebody from the technical side can have a look at it about the sound. So in respect of the PI project, since 2010 and 11, there has been a comprehensive definition. So while the International Board will do some changes, I don't think it will capture quite a lot of more entities than that's already captured in the Australian definition. One may ask why all these changes given the recent restructure of the code. The restructured code, as I said, is primarily responding to some failings identified post-GFC and was internationally issued in April 2018 and in Australia by APESB in November 2018. However, from the latter half of 2017 and 2018, there have been reported audit failures in the UK, South Africa, and which have led to some reviews into the profession. As you would be aware, there's ongoing review in Australia as well, and Doug will be speaking more about that in his presentation. There have been common themes emerging in these reviews with respect to the provision of non-assurance services and fees, and that is why the IESBA are reviewing these provisions of the code. The fee proposals aim to address concerns such as the audit fee should not be influenced by any other services that you may be providing to the audit client. For PIs, firms must cease to act as an auditor if there's a fee dependency, and currently the proposal says it is 15% of revenue of the firm, and if that continues beyond 5 years, then they are proposing that you need to discontinue. For non-PIs, there's a proposal that it should be at 30%, but this is still being worked at the international level, so we don't know what the final position would be at this stage. There's also enhanced communication with those charged with governance to provide more transparency. So both on the fees and the non-assurance services, the International Board is aiming for completion in December 2020, and at their September board meeting, they'll be looking at the respondents' comments that have come from all over the world. The NAS proposals or non-assurance services proposals are aimed at restricting other services an auditor can provide PI audit clients. And what they're saying is where there is a self-review threat, then you shouldn't be carrying out that service. Currently, there's a materiality qualifier in the code, which suggests that if it's immaterial in certain circumstances, you may be able to provide it. But the proposal is to remove this materiality qualifier. So for public interest entities, materiality will no longer be a factor in determining whether non-assurance services can be provided. For non-audit PI clients, the proposal is to retain the materiality description as well as clarify that materiality is relevant. But I have seen some recent discussions that they are considering whether it should be even taken out in respect of non-PI audit clients. For PI audit clients, firms must also obtain concurrence with those charged with governance, such as the audit committee or board, before providing the non-assurance service to the audit client. I mean, these things, some of these are not such major issues in Australia because I think auditors do communicate with boards and audit committees. They have also started a benchmarking project, and that is comparing the requirements of the code's independence requirements with the US SEC and PCAOB rules. They aim to do a detailed analysis and to complete this project by June 2021, and that is to demonstrate the true differences between the two sets of independent standards in an authoritative manner. So let's look at the independence guide. The previous 4 versions of the independence guides were developed by the professional accounting bodies, including CPA Australia. The new 5th edition is a collaboration between APESB and the 3 accounting bodies. APESB's involvement is partly due to the need to ensure alignment with the restructured code. This guide was issued in late May 2020 and incorporates over 50 practical examples for accountants to understand the application of the conceptual framework to auditor independence matters. Some of the key chapters is Chapter 4, which goes through the conceptual framework. Chapter 5 discusses public interest entities. Then Chapter 6 deals with network firms. The bulk of the auditor independence examples are in Chapter 7. So that is sort of the key chapter. And then Chapter 8 deals with SMSF Auditor Independence issues. The Auditor Independence requirements in the code are in Part 4A and 4B. Part 4A deals with the independence requirements for audits and reviews of historical financial statements, and then Part 4 deals with all other assurance engagement. If you provide multiple assurance services to a client, which includes an audit or review of financial statements, then you will always come within the requirements of Part 4A, which are more stricter which are the most strict auditor independence requirements. Some issues we have covered in the examples about fees. This is about the dependency issue, which, as I touched on before, currently for PIEs, it's a 15% threshold. And in the current code is if you are at that level for 2 years, then you need to disclose to those charged with governance and also determine whether you need to conduct a pre or post issuance review. With respect to gifts and hospitality, there are new provisions, Section 340 inducements, which deal with it. And auditors should not be on the receiving end of excessive gifts or hospitality. And this was a specific example in South Africa as well. There are also prohibitions on financial interest, loans and guarantees, business relationships, and family and personal relationships. These are covered in Section 510 to 520 of the code. These have not changed that much, except there's more clarity around the requirements. And these provisions actually become more complicated with the overlay of the Corporations Act. And we explore some of these in examples 8 to 17 in the Independence Guide. There are also several examples dealing with charities and the independence threats created in that environment. For example, if an auditor is providing accounting advice with respect to the implementation of a new accounting standards, developing accounting policies, and even giving the relevant accounting entries, in circumstances that the charity does not have finance personnel who can take management responsibility, then that creates such an independence threat that the only option is to disengage from one activity. Let's explore this issue of management responsibility a bit further. At Section 600 of the code, it deals with the provision of non-assurance services to audit clients. And there's a clear explicit prohibition on an auditor undertaking a management responsibility. Further, to avoid the auditor assuming a management responsibility, the auditor or the firm needs to be satisfied that when providing another service, that the client management makes all judgments and decisions that are the proper responsibility of management. If the client does not have a person who can oversee and assume management responsibility, then the auditor cannot undertake the other service. Let's look at some services. Tax services. Generally, the preparation of a tax return based on the client's historical financial information does not create a threat to independence. However, providing assistance with tax effect entries which are material to the financial statements does create a threat to independence. And in the case of PIEs, it is specifically prohibited. Another example is IT software. In the current environment, there are some firms who have developed software solutions to deal with AASB 16 leases. When you apply the conceptual framework in the code and Section 606, which deals with IT systems services, you will come to the conclusion that a firm must not sell AASB 16 lease software solutions to its audit clients. With regard to recruitment services, one of the significant changes in the restructured code was the extension of the prohibition of the recruiting services for a director, officer, or a person who can exert significant influence over accounting records of financial statements from PIEs to all audit clients. So there are certain prohibitions that you need to be aware of, and we will get to a document later on where there's a useful summary. Then getting on to SMSF auditor independence issues, which are dealt with in Chapter 8 of the guide. Generally, the restructured code has a prohibition on an audit undertaking bookkeeping and accounting services, whether you are a public interest entity or a non-PI. However, for non-PI audit clients, such as SMSFs, there is a limited exception. The limited exception applies in circumstances where, one, there is a party who can take management responsibility. In a company scenario, it would be a CFO or financial controller. And in a SMSF, it would generally fall to the trustee. Two, the service is routine or mechanical. And three, you can implement an appropriate safeguard. From an SMSF context, if a firm is undertaking all the accounting work and compliance activities, in circumstances where the trustees are not financially literate, then the firm is in effect functioning in the role of management. The consideration of whether the accounting and bookkeeping is routine or mechanical is largely irrelevant, as the audit firm would not be able to overcome the management responsibility prohibition. In circumstances where the trustee of an SMSF is financially literate and has the necessary skills and expertise and has the ability to understand and oversee the transactions that are occurring in the SMSF, they may be able to take management responsibility. However, you will then need to consider whether the accounting and bookkeeping service provided is routine or mechanical. Accounting and bookkeeping services that are routine or mechanical in nature require little professional judgment. For example, it may be posting client-approved entries to the trial balance or preparing financial statement based on information in the client-approved trial balance. I know Kelly will speak more about this topic from the ATO's perspective in the SMSF context in her presentation. The remainder of Chapter 8 provides guidance in various contexts. For example, a previous employee or consultant carrying out services for an audit firm, relationships between auditors and referral sources, in circumstances where a significant proportion of fees may be coming from a specific source, reciprocal auditing arrangements, and then financial planning services also creates threat to independence. For example, if the audit firm has recommended a particular financial product or investment arrangement, then that creates independence threats if the same firm does the audit. I understand Kelly will be covering some of these issues from the ATO's perspective and what they're seeing in their inspection activities. So other related APESB publications that will assist members, there's a revised technical staff Q&A on audit partner rotation, which was issued in November 2019. There's 40 plus Q&As on partner rotation requirements and also useful flow charts to determine the cooling off periods in various circumstances. As I mentioned earlier, we just issued last month a code prohibition summary, which is available from our website, and I think CPA Australia will put appropriate links to that as well. And that provides a useful summary of prohibitions across all audit clients, not just PIs. Also, members should be aware that if you download the PDF versions of the code, the independence guide, and the APES 110 code prohibitions documents, there is enhanced PDF features which will allow you to navigate quite easily within the documents. And even there's links to external websites as well. So further information, you can get it from our website or follow us on LinkedIn, and we have a couple of apps as well on Apple and Google Play that are linked with our websites, and you can get timely updates that way. As noted at the beginning of the presentation, when ethical lapses occur, there is public dissatisfaction on the conduct of auditors. It leads to inquiries like the current PJC inquiry into audit regulation, which Doug will go into more detail. And over time, it is likely to lead to stronger regulation and increased level of prohibitions to maintain public trust and confidence in the role of an independent audit function. This is not an optimal result, and it reinforces the need for auditors and professional accountants to uphold the code, including the independent standards. The accounting profession has a major role to play in contributing to maintaining the public trust and confidence in the value of an independent audit function, whether as auditors or as accountants in various financial reporting roles, providing input to decision makers, which ultimately determines the efficient allocation of resources in capital markets, private and public sectors, and other entities in the economy. I will now hand over to Doug Niven of ASIC, who will speak about ASIC's focus on auditor independence. Thank you.
Thank you very much, Chana, and I also would like to thank CPA Australia for the opportunity to participate today. Similar to Chana, we have obviously a very strong focus. Helps if I move the slides in the right direction. We have a very strong focus on auditor independence in our regulatory activities, both in relation to companies and also SMSF auditors. And obviously, Kelly will talk more extensively around the SMSF auditors. But as a securities regulator, you can understand that we're concerned about confidence in financial reports, that you've got confident-informed investors and users of financial reports. And that's fundamentally underpinned by the quality of the independent audit and the independence of the auditor. If you reflect back to the UK Bumble Act, which gave rise to the whole concept of auditors in the first place, it was all about stewardship and accountability and the need to have that independent assurance. And that's really where the value of the audit comes in. Now, in recent times, questions have been raised around the value of the audit, partly because of some of the matters that Chana referred to. Some of the collapses in Japan, very public matters, South Africa, and of course in the UK. And so in that regard, it's worthwhile just reflecting on some of the things in the international environment. For some time, of course, we've had a range of different independence requirements globally. Historically, you've had legislative and regulatory requirements around independence in each jurisdiction, and there are quite some differences in those. There are similarities as well, but that does create challenges for companies and also auditors who are operating across borders. You do have the Code of Ethics, and obviously the IESBA takes care of that internationally, and the APESB here, and we're very pleased to work with Chana and also the International Board in relation to that code. But again, there are variations to that code in different jurisdictions. Thankfully, in Australia, it's more adding to the requirements rather than taking away. But in recent years, because of those high-profile collapses, and earlier than that, the global financial crisis, as Chana mentioned, various initiatives have been looked at, particularly in Europe, around how you can strengthen auditor independence and confidence in the audit process. So you will be aware that in Europe and the UK, mandatory firm rotation was adopted, not necessarily in the same timetables. That's not something that we've supported in Australia because we are conscious of possible negative impacts on audit quality due to the focus on tendering and changing auditors in the final years and knowing that you'll no longer be the auditor. Obviously, we expect the auditors to do their job and new auditors to invest when they become the new auditor as well. But in recent times, following Prohibition and so forth in the UK, there has been a renewed focus and a number, four inquiries in fact, in the UK, and various proposals around auditor independence. The larger firms themselves decided that they would stop providing certain non-audit services to the larger listed companies in the UK. And that's since been adopted by the UK Financial Reporting Council in their version of the Code of Ethics. In recent months as well, you may be aware that there have now been proposed principles issued by the UK Financial Reporting Council that go even further, based on concern about the possibility of audit being cross-subsidised by other service lines, particularly in the larger firms. Now, we do understand the situation is different in the UK, that historically a lot of their transaction services work and so forth has been more profitable than audit services. But this has led to the idea that there should be some form of separation within the firms. Now, we were concerned, like many, that auditors do actually rely on the quality of support services, whether it's tax, valuation advice, and being able to work with others in the firm where they have quality control processes, they're familiar with the audit processes, and also the auditors are familiar with their work, that there are advantages in being able to have a multifunctional firm. That doesn't necessarily mean, of course, providing extensive non-audit services to those companies that are actually audited. But in the UK, as I say, because of this concern that cross-subsidisation might lead audit partners to focus on selling and retaining non-audit services, that there would be advantage in separating in some form and not a complete separation those non-audit services and those non-audit service lines. What they're looking at is independent governance, governing boards, some internal processes around the possibility of cross-subsidisation, and enhanced reporting. In the UK, by the way, audit firms are limited liability partnerships, and they do actually report the results publicly. The thought is that they should report at least to the UK Financial Reporting Council on the results of their audit practice. I should say that those sorts of proposals haven't been focused on in other jurisdictions, North America and here. Particularly here, it's not the case that you have the same level of cross-subsidisation. In fact, audit is actually performing quite well. It's certainly true that audit partners share in the pool of profits, but you don't have the same driver behind this. So there are some distinctions there. But nevertheless, there is a strong interest in conflicts of interest, objectivity of the auditor, independence. And in Australia, before I get to the developments, I think it's worthwhile just reflecting on where we are at the moment. And Chana has covered this, and he's covered the Code of Ethics much more extensively here, but I'll perhaps just start with that and come back to the Corporations Act. So the Code of Ethics does actually have the indirect force of law under the Corporations Act through a legally enforceable auditing standard. So it is actually possible to take enforcement action in relation to breaches of the Code of Ethics. In addition, the Superannuation Industry Supervision Act for self-managed super fund auditors does also have requirements around compliance with the Code of Conduct, Code of Ethics. In the Corporations Act context, and Chana touched on some of the provisions of the code, but there are direct provisions that were introduced with CLERP 9 a number of years ago, the last set of major audit reforms to the Corporations Act, which deal with business, employment and financial relationships. They've also introduced, and this was following HIH, limits on the number of partners from an audit firm who can be directors or officers of an entity, but also very importantly for listed entities, there is a partner rotation requirement. There is also a requirement in the code, but in the Act it's to rotate the audit partner and any review partner each 5 years. Now, one of the things that needs to be borne in mind is that as well as specific requirements in the legislation and in the Code of Ethics, there is a general requirement in the Corporations Act around conflicts of interest. So even if there's no specific requirement, or if there are concerns that go beyond any of the provisions in the code or in the Act itself, then you need to consider whether the objectivity of the auditor could be affected, whether there is a conflict of interest. In those circumstances, and where there's any breach of the specific independence requirements of the Act, there is a requirement to notify ASIC. If the matter is not resolved in a period of 21 days, then the auditor actually automatically ceases to be the auditor. So that emphasises the importance of these types of provisions. Now, there are certain provisions around whether there are penalties, if there's systems of controlling and so forth, but fundamentally, you can see the importance of auditor independence. There is a requirement for an auditor's independence declaration to be made by the auditor at the time of the financial report, and that forms part of the director's report. In addition, in the case of the listed entities, there is a requirement for directors to opine upon whether the provision of non-audit services, looking backwards for the year, has compromised the independence of the auditor, and do that on the advice of the audit committee where there is one. So it's not just a matter for the auditors to worry about auditor independence. Fundamentally, it is a matter for directors and management to think about independence. And when you think back to the fundamental starting point, confidence in markets, confidence in financial reports, it is actually in the interest of directors and management to support both audit quality, but also the independence of the auditor. So I said I'd move on to some of the domestic developments, and I thought it was worthwhile starting with an overview of some of the things that have happened in recent years, particularly focusing on auditor independence. So we had the Financial Services Royal Commission. Its report said to ASIC, well, and it wasn't in the financial reporting audit space, but it fundamentally applies across our activities. You shouldn't really be making settlements with parties who have contravened the requirements. You should be dealing with them through enforcement mechanisms, including court actions. In the budget that followed that, ASIC was given significant funding for the Office of Enforcement to be established, greater funding for enforcement actions, and audit is one of the priorities in that space. Then later in that year, of course, as Chana has mentioned, the Parliamentary Joint Committee on Corporations and Securities was given the task of making an inquiry into the regulation of auditing in Australia. It gave its interim report at the end of February, and it will, now has a deadline to finish its work 2nd of December. That was extended a couple of times. There will be further hearings in November. But you're probably wondering, well, what were their recommendations if you don't already know? And there were 10 recommendations in the interim report. Now, that did have bipartisan support on the committee. It hasn't been subject to a government response, which won't occur until after the inquiry is finished. But on that slide, you'll see the 10 recommendations in summary form. The ones in italics are the ones that relate to auditor independence. So number 3, and there is an overlap obviously with the code and what Chana's been talking about, the Financial Reporting Council and ASIC. The recommendation is that we think about greater disclosure around audit and non-audit fees, and some of that work had already started prior to the inquiry, but also consider prohibitions around non-audit services. And there were a large number of submissions to the inquiry, and including audit firms seeking greater clarity around prohibited non-audit services. And it's good to hear the work that's going on internationally with the code. The Auditor's Independence Declaration should state if there are any prohibited non-audit services provided. Specifically, the APESB, which Chana's representing, look at incentives to sell non-audit services, so that has a bit of a tie-in with the earlier recommendations. Disclosure of audit tenure. Now, that's not mandatory firm rotation, but when you look at number 7, they are talking about a requirement to tender every 10 years on an if not, why not basis. So you don't have to tender if you've got a reason. Now, there are a couple of these recommendations where there are questions about if they did go ahead, which entities they should apply to. Also, if there was to be some form of tendering, mandatory tendering, perhaps there'd have to be some staggering so that all tenders didn't occur at the same time. But just to move on quickly, I thought it was worthwhile touching on the fact that obviously as a part of our regulatory activities as well as enforcement, we do have surveillance and compliance activities where we work cooperatively with firms through our audit inspection program. A number of the findings in that area do relate to auditor independence, and we did a specific review on conflicts of interest over the last 12 months, as well as our normal activities in that area. One of the biggest findings was a failure to focus on the general independence tests and principles, but rather the bright line rules you can find in the codes and legislation. And it is important to think beyond that. That's a matter of culture in the firm, looking at client acceptance and continuance and provision of services in the non-audit space, but also quality monitoring. Need to have a greater focus on threats and safeguards and whether they're effective, including where some of the safeguards don't go beyond what you would normally do. But also we did actually contact some companies and some firms in relation to cases where the size and type of non-audit services appeared to be out of line with what would be expected. Hard to talk publicly about those matters, but certainly one matter where there were significant audit fees non-audit fees relative to audit fees is being resolved by the auditor and the company making a decision that it would be appropriate to change auditors in that particular situation. Obviously, from time to time, we also do have some issues with partners not adhering to the rotation requirements, and that can be a particular issue at the smaller end of the listed market, where perhaps there's not as much capacity for rotation, and it may mean that in some cases firms do need to change. In addition, I thought it was just worthwhile touching on a few other aspects that we're seeing. Clearly, we hear from time to time, and this is including in the SMSF auditor space, fee pressures. The bottom line is audit quality is non-negotiable. Audit quality needs to be adhered to irrespective of fee pressures. It's important, probably preaching to the converted in terms of those who've turned up to this session today, but don't be part of the problem. You just compound it if you give in to those fee pressures and compromise audit quality. The better course, of course, is to refer matters to the ATO or in relation to SMSF auditors or to ourselves in relation to Corporations Act audits. Perhaps won't go through all of the detail here, but certainly on non-audit services, it is important where there are concessions to actually make sure that management really has taken responsibility for any services and that they actually have the capacity to do so. I couldn't help but mention COVID-19. Even though this is on auditor independence, it does create some challenges because there are for companies more difficult judgments around asset values, going concerns, solvency, provisioning, and also disclosures in financial report, the operating financial review. It's so important that the auditors are not advising in an area and can't be preparing the information and also conducting an independent audit. So we do recognise there are some interesting grey lines where the auditor needs to challenge what the company has produced, but fundamentally they should not be advising. That's the role of management and the directors. And lastly, before I hand over to Kelly, just wanted to give a few messages on SMSF audits. It's actually the ATO, by the way, that does the actual surveillance work. They refer matters to us as a registration body for SMSF auditors, and then we make decisions after sending show cause letters and hearing from the auditors as to whether we would, for example, disqualify or cancel registration or suspend auditors. And auditor independence matters as well as audit quality issues have been very important in that space as well. We often find cases, or I should say the ATO, because I'm using the plural here, finds cases where an auditor might be auditing their own fund or that of a close family member. Typically that will lead to a deregistration. Now, the focus on SMSF auditors, you might say these are small funds, but when you think about it in terms of the economy, the importance of compliance, the tax situation, but also the sheer dollar value in these funds, which is well over $1 trillion, you do need to look at it in that context. We also have cases where, again, auditors are auditing funds in which their relatives have an interest. I'm sure Kelly will talk more about that self-review threat, bookkeeping services and so forth. But I'm conscious of the time, and so I think it's important just to, again, re-emphasise, again, perhaps preaching to the converted, the importance of auditor independence. That's what auditors are there for. And it's so important to provide that independent assurance and the confidence in financial reports, and in case also of SMSF audits, compliance matters as well. But I'll leave it there for the moment and hand over to Kelly from the ATO.
Yeah, look, thanks, Doug, for that. And thank you as well to Joe and Claire and the CPA for having me here today to talk about independent standards in the context of self-managed super fund auditors. So I'm just going to start off by telling you a little bit about what the work we do here in the ATO, and Doug also touched upon it at the end of his presentation then, which was a good segue actually into what I'm about to say. So as a co-regulator with ASIC, of course, the ATO is responsible for ensuring SMS auditors comply with independent standards. And each year we'll use our data to detect possible independence breaches by the auditor. So for instance, we can data match the name of the self-managed super fund auditor with the name of the trustee or the member reported in the actual self-managed super fund annual return, and that might indicate that the auditor has audited their own fund. We also data match the surname of the auditor with the same surname of other self-managed super fund members on the annual return to identify potential family relationships and whether that auditor might be auditing the fund of relatives. And we identify potential in-house audits if the self-managed super fund auditor is from the same practice as the tax agent reported on the annual return. Now, that doesn't, of course, necessarily determine that the financial statements were also prepared in-house, but we then do investigate further to see if the tax agent also prepared those funds accounts, as that could amount to an independence breach. And since co-regulation commenced with ASIC on the 1st of July 2013, despite the constant messaging to auditors about the importance to comply with the independence standards, the ATO actually still find ourselves referring a number of auditors to ASIC each year for independence breaches. So this graph here actually shows you in dark blue the number of referrals we've made to ASIC each year, and the lighter blue bars actually show you how many of those comprised independence breaches. And as you can see, more than half of those actually did comprise independence breaches. So, of course, independence comprises independence of mind and independence in appearance. So when assessing independence, the auditor should identify any threats to compliance, evaluate whether those threats are an acceptable level, and if they aren't, eliminate those threats or apply appropriate safeguards to reduce them to an acceptable level. And failing this, they, of course, should then decline the audit engagement. So the restructured code and new guide make it clear that there are certain arrangements for which no safeguards can be put in place to reduce those independence threats to an acceptable level, and these are the ones where the auditor should be declining the engagement. So, of course, these include auditing your own fund or that of a relative, and we still see a number of these each year, these sort of breaches. And in recent years, we've also seen many auditors refer to ASIC as a result of auditing a self-managed super fund, where they themselves or their staff have prepared the self-managed super fund financial statements. And we've also referred a handful of auditors for auditing their business partners fund or fund that they actually had a direct financial interest in, or again, auditing a fund that they actually provided financial advice for. Reciprocal auditing arrangements and sole referral sources have also constituted reasons for why we've referred auditors to ASIC. And other than for auditors who have audited their own fund, who we just refer through to ASIC on that basis alone because it's such a blatant independence breach, We also find that with respect to some of those other independence breaches, such as the auditor also preparing the accounts, that we do find most of them have poor quality audits as well. So there is a clear correlation there. And also over the years, we've found that ASIC have usually disqualified auditors for blatant breaches of the independence standards, like auditing your own funds or that of a relative. And so maybe for some of the less blatant independence breaches, we're also finding ASIC will impose conditions in relation to those auditors. So because we are still seeing a lot of independence breaches each year, we really welcome further guidance such as that was recently provided in Chapter 8 of the new Independence Guide to help self-managed super fund auditors comply with the code. So the new guide, of course, provides additional practical examples and some new scenarios for auditors to consider, such as auditors who audit a fund where the auditor was previously a consultant or partner or employee of the firm, relationships between auditors and referral source, including reciprocal auditing arrangements. Referral sources in regional areas is a new example that's been added. That's because when we do a lot of our auditor reviews, we found for those auditors in regional areas, they really only wanted to accept audits from, only one or two sort of accountants in the local area that they knew. And that situation, of course, can increase threats to independence due to close relationships and familiarity. So the guide actually sort of says that auditors in this situation should look to take on more work and increase their referral sources outside their local country area. Another new example is auditors who contract out the accounting work, where there's a close relationship with the auditor and the contractor. This can create familiarity threats, as the auditor may just be too accepting of the contractor's work. And finally, another situation or a new example that's been added to the guide is that long association that some auditors have with their self-managed super fund clients. The guide actually talks about a 10-year relationship as possibly giving rise to sort of self-interest and familiarity threats. And in that situation, the auditor could look to implement safeguards such as using another auditor in the firm to arrange an audit for that client, or using an internal or external independent reviewer to undertake that audit. But perhaps the biggest change in the restructured code and the new guide is the impact it's now going to have, we think, on in-house audits. So some firms may think they can perform both audit assurance services for a trustee as well as provide, non-assurance services such as the preparation of fund accounts, as long as they have those two separate divisions and lines of reporting to two separate partners. This practice of separating the auditing from the accounting services in the same firm to allow in-house audits is often referred to, of course, as Chinese walls. However, the restructured code and the new guide now make it clearer that this structure that has been set up to purportedly allow for in-house audits is prohibited and now can only take place in very limited circumstances. And this is because there are effectively three hurdles or problems that need to be overcome before this type of arrangement could be acceptable under the restructured code. And in a self-managed super fund context, where the trustees normally hand their fund over to their administrator or accountant to manage for them, these hurdles are even more difficult to overcome. So the first problem for an in-house auditing firm is the code actually says a firm or network firm shall not assume a management responsibility for an audit client. The second problem is that the code says that in order to avoid assuming a management responsibility, the firm must be satisfied that the client, or in this case, the self-managed super fund trustee or trustees, make all judgments and decisions that are the proper responsibility of management. And the third problem is that if the firm or network firm are looking to provide an audit client that does not apply accounting and bookkeeping services, including preparing the financial statements on which the firm will express an opinion, well, they cannot do so, of course, unless those services are of a routine or mechanical nature, and the firm addresses any threats that are not at an acceptable level. So let's now examine each one of those problems in more detail in the context of a self-managed super fund audit engagement. So the first problem facing firms who do in-house audits, as I said, is the code states that a firm or network firm should not assume a management responsibility for an audit client. Now, a firm is defined in the code as a sole practitioner, partnership, corporation, or other entity of professional accountants and entities that control or are controlled by those parties. And a network firm is defined in the code as a firm or entity that belongs to a network, which is a larger structure that is aimed at cooperation and that is clearly aimed at profit or cost sharing or shares common ownership, control or management, common quality control policies and procedures, of common business strategies, or the use of a common brand name, or they share a significant part of professional resources. So if you're part of a firm that has an office in a number of states and you're looking to swap audits between those offices in different states, you may be thinking that you're not breaching the standards because there may not be any profit sharing between those offices in those states. But you're still likely to be caught. There's still likely to be an independence breach there because you're still likely to be sharing common business strategies and brand names. So you need to be aware of that as well. Management responsibilities also include in the code setting policies and strategic directions, authorising transactions, controlling or managing bank accounts or investments, deciding which recommendations of the firm or network firm to implement, reporting to those charged with governance on behalf of management, and the preparation and fair presentation of the audit's client's financial statements. So in the context of self-managed super funds, these types of management responsibilities are often handed over to the fund's accountant or fund administrator to manage on behalf of the fund. And they don't only have to include preparation of the financial statements. You know, they might include many other decisions made on behalf of the fund, from the time it's set up to how it performs in accumulation and then in pension phase. So, for example, you know, the administrator will often set up the self-managed super fund by arranging execution of the trustees and the trustee declarations, and they might help draft investment strategies. And then they might offer advice in relation to fund investments, like how the fund would go about acquiring property or business real property, what sort of contribution should be made into the fund without breaching the caps. For funds investing in certain simple assets like listed securities or cash, either directly or via managed investment schemes, that administrating firm might actually set up the data feeds needed to capture the income derived on those investments. And they might also advise trustees on how they can remain compliant with the SISA rules in relation to in-house assets or borrowings or sole purpose tests. So before one even gets to the point of considering whether the preparation of financial statements by the firm may be considered to be routine or mechanical, the auditor first needs to ensure that their firm does not take on any management responsibilities for the client. Because then if an auditor in the same firm or network firm was to then conduct the annual audit on a client, there would obviously then be clear self-review and self-interest independent threats that would arise. So we think the restructured code now makes it clear that regardless of there being separation of duties between the accounting or advisory division and the audit division in the same firm, that we think the Chinese walls can no longer be applied where that accounting or advisory division is essentially acting as the manager of the trustee for the self-managed super fund. So the second problem for in-house auditing firms is that the code says that to avoid assuming a management responsibility, the firm must be satisfied that the client, or in this case, the self-managed super fund trustee, makes all judgments and decisions that are the proper responsibility of management. This includes ensuring that the trustee's management possesses suitable skill, knowledge and experience to be responsible at all times for the trustee's decisions and to oversee the services. And such an individual would understand the objective nature and the results of those services. And the trustee also needs to provide oversight of the services and evaluate the adequacy of the results of those services. And finally, the trustee must accept responsibility for the action, if any, to be taken arising from the results of those services. So we interpret that to mean that if the fund was to incur a loss, due to a bad investment, that they could no longer look to sue their accountant for any sort of negligent advice in that respect. And of course, we don't think there'd be too many trustees that would have the requisite skills, knowledge and experience to take on management responsibility for their funds, including being able to take on that full responsibility for preparing the financial statements. As I said before, most rely on their fund accountant or administrator to make these sort of management decisions for them to ensure that their super fund complies with the super laws going forward. So the third problem is that, generally the restructured code has a prohibition on an auditor undertaking bookkeeping and accounting services for the audit client, whether you are a PI or a non-PI. So for non-PIs, which of course are self-managed super funds, there is a limited exception. However, the problem is that is very difficult to meet. That limited exception applies in circumstances where, firstly, the trustee can take management responsibility for the fund, secondly, that the service is routine or mechanical, and thirdly, that appropriate safeguards are implemented. So from a self-managed super fund context, if a firm is undertaking all the accounting work and the trustees are not financially literate, then the firm is in effect functioning in that role of management. So then, as I said, the consideration of whether it's routine or mechanical is largely irrelevant then, as the firm will not be able to first overcome that management responsibility prohibition. In circumstances where the trustee of the self-managed super fund is financially literate and has the necessary skills, expertise and the ability to understand the transactions that are occurring in the self-managed super fund, they may be able to take on that management responsibility. So in these circumstances, you'll then need to consider whether the accounting and bookkeeping services provided are routine or mechanical. Accounting and bookkeeping services that are routine or mechanical in nature require little or no professional judgment. And some examples of these services are included in the definition of routine or mechanical in the code and include posting transactions coded by the client to the general ledger, posting client-approved entries to the trial balance, preparing financial statements based on information in the client-approved trial balance, and preparing related notes based on client-approved records. So to meet this requirement, the auditor will need to show evidence that the trustee took on full responsibility for the fair presentation of those financial statements, and it goes beyond the trustee just signing the trustee declaration in the financial statements or saying in the trustee representation letter that they've prepared the financial statements. It actually means the trustee being able to show they coded all the fund transactions and have basically provided a trial balance to their fund administrator to upload it into their system. Any financial statements then produced will be based on those trial balance figures prepared by the trustee, so the accountant has made no judgment as to how certain items should be classified in the accounts. Again, there's not probably too many trustees that would have the knowledge, skills and experience to take on the responsibility of those financial statements in that way. And so we expect many accounting firms who conduct in-house audits will be looking to restructure to avoid breaching the independence standards. So once again, even where the preparation of financial statements is routine or mechanical, the Commissioner and ASIC, as a reasonable third party, require the auditor to use safeguards to reduce threats to an acceptable level. So examples include using professionals who are not audit team members to perform the service, or using an appropriate reviewer not involved in preparing the accounts, review the audit work or service performed. So for those firms or network firms who think they can continue to do in-house audits under that very limited exception, we expect to see on the auditor's file, when we undertake a compliance review, evidence that the trustee is financially literate and has classified and valued all fund transactions. And we may contact trustees to actually test their knowledge and verify whether they prepared that supporting documentation. Once again, signed financial statements and trustee representation letters will be insufficient there. So finally, during the 2021 financial year, the Commissioner will write to all auditing firms to provide further guidance on the independent standards relating to in-house audits, including the rules prohibiting management responsibilities by the auditing firm and that definition of routine or mechanical. We'll also provide guidance on what evidence we require to see on the audit file to demonstrate the standards have been met, and also talk about some of the further independence issues that you need to be aware of when restructuring. We'll also write to all auditing firms because, as I said before, we can't clearly identify all firms conducting in-house audits at the moment because of the way in which the annual return is structured, where it just asks for the auditor details and the tax agent details. But we hopefully, for the 2022 year, when we look to start taking a compliance approach, we hope to change the SAR so that we do capture that information and we know which firms could still be conducting in-house audits. And just finally, when a firm is looking to restructure their audit engagements, as I said, just need to be careful about not entering into other reciprocal auditing arrangements that create further independence issues, or looking to have some auditors set up their own firm and then accept audits from their previous firm, because their judgment may also be clouded there if they're still familiar with the clients of their old firm. The guide actually suggests, I think, to wait at least 2 years before those independent threats would be reduced to an acceptable level. So that really concludes my presentation there. I might throw that back to you now, Jo.
Thank you, Kelly. We do have some time remaining for questions today. So, Josephine, I will unmute your mic.
Thanks very much, Siobhan. Our first question is to Channa, and it's from one of our members on session today. Not all threats can be addressed by safeguards. So what are these threats? And so what are the threats that are no longer able to be mitigated by safeguards? And if threats cannot be mitigated by safeguards, what's the general expectation to resolve these identified threats? Channa, you may want to refer here to the prohibitions that was recently, the prohibitions guide that was recently released by the APESB.
Yes, thanks, Jo, and thanks for the question. Yes, the prohibitions guide, I think there's a link in the chat pod as well. We'll provide the summary of it. I mean, there's no new threats. It's still the old threats. It's whether the activity that you do would end up in the financial statements. And, there could be services that you provide that has nothing to do with the financial statements and the internal control environment. It becomes a problem when it forms part of the internal control environment or part of the financial statement, such as a valuation of an asset. The thing is, in the previous code, because the guidance and the requirements were mixed, it could be read in different ways. So, like, for example, a regulator reading it might take a stricter view, while someone else might have a more relaxed approach. But by the separation of the requirements and guidance, it now makes the black letter requirements very explicit, and that you must comply with, similar to the accounting and auditing standards. Is that...
Thanks very much, Channa. I think that addresses the question well. And just to highlight the fact that the APESB have recently released a short form guide on prohibitions for all audit services, or for those services that create those particular self-review threats. Now we have a question for Doug. Doug, we saw huge Australian listed entities and some entities that are also listed via a UK dual listing, such as BHP and Rio Tinto, recently changed their principal auditor from a Big Four globally From an Australian perspective, has ASIC identified any positive outcomes so far or any downfalls of these compulsory requirements in the UK?
Yeah, so without opining on the circumstances of particular companies, which changed from are dual listed, Australia and the UK, and moved from one big four firm to another. It goes back to the comments about, well, initially in the UK it was mandatory tendering, but aligning with Europe prior to Brexit, of course, mandatory firm rotation. And there are some advantages and disadvantages in mandatory firm rotation. And so, on balance, we don't see it worth pursuing in Australia. However, you can certainly understand the concerns with long associations, where a very large entity, an auditor has been the auditor for a long period of time, possibly decades. It's partly about bringing fresh minds, and some of that can be achieved through partner rotation and changes in offices, but there can be the perception that it would be embarrassing for a firm to lose a client that they've had for a period of time, and for the audit partner within the firm to lose a substantial amount of audit fees. So in a sense, that's one side of the equation. But the other part of it is the difficulties and the possible negative impacts on audit quality. As I say, when you take on a new client, no matter how major it is and how complex, you still need to perform the audit work, and that may mean a bigger investment in the first year. But there is a concern also at the other end, because you can't be the auditor after a period of time, that you may take the eye off the ball and be more concerned about the tendering process and getting the next piece of work. There are also some problems in Europe because they had different rotation periods and different start dates, which were causing disconnects between entities within one group. So there are pros and cons. I won't go through the whole list, but certainly you can see from PJC's perspective, disclosure about the period was something that they were focused on, the period of tenure. And also they have this concept of mandatory tendering, if not, why not, which leaves the matter within the control of the company, and it's still possible, having been through the process, to actually retain the auditor. Having said that, we have put out an information sheet which talks about how audit committees can support audit quality. Independence is a key part of that, and other aspects around the fees. Now, the reason I mention that is one of the features that occurred in the UK was you'd find that in the tenders, potentially the fees were going down, but also they had a competition objective, which was to give more work to the smaller firms. And what actually happened in the UK was that there was a greater concentration as a result of these changes in the larger firms. So it was actually achieving the opposite. And to the extent that Grant Thornton came out publicly and said, look, we're just not going to bother tendering for FTSE 350 companies anymore because of the cost involved. So it's not a simple question. Clearly, independence and perceptions are paramount, and objectivity. But this particular idea does have pros and cons. Obviously, we're very supportive of partner rotation, which exists both under legislation and code.
Thanks very much, Doug, for that very comprehensive answer. Now our next question is for Kelly. Kelly, this question may involve fee-dependency type issues. So I can just refer you to this particular question. It's from a member that's asking, if a firm organises 4 other accounting firms to partner up and have one large pool of super funds to audit, does this constitute an independence risk? How many firms would need to partner to lower the independence risk to an acceptable level?
I suppose, Joe, without knowing exactly, how complex are the audits as well in relation to the fund. I know that if you're just going to look at partnering up with other firms, just be aware of those reciprocal auditing arrangements, which I said again, just make sure that you've got a good number of referral sources in place. And I mean, in that situation as well, I'd be happy to take that question if that particular one can be forwarded to me. And I'm happy to take any questions actually if you send them to my email address, kelly.grant@ato.gov.au, to have a look at some of those questions around what sort of restructuring arrangements are acceptable, because I understand, well, we are starting to get some of those questions ourselves, Joe, and we'd be looking to also work with the APESB there in answering any of those queries, just to make sure that we're adhering to the code. So happy to take that one as well and give it a little bit more thought and get back to that particular person that's asked that question.
Thanks very much, Kelly. Chana, do you have any very general comments to make around fee dependency issues within the code?
So there's a provision in the code, it's in section 410, and this was developed originally when the SMSF independence requirements came in, and it's Australian edition, which talks about, getting multiple audit clients from the same referral source. So members need to be aware of those fee dependency issues. And I mean, similar to what Kelly says, it's really difficult to sort of provide a pathway without knowing the facts and circumstances. So I think it's best if people who have those sort of questions send it to Kelly, and then we can provide some support to the ATO in responding to those questions. There's no magic formula to deal with it, and it will depend on each member's circumstances.
Thanks very much, Chana. And actually, the next question is for you, Chana. At what point would a non-assurance service constitute or imply a potential self-review threat?
I mean, as I said earlier, I think the trend is if the non-assurance service results in something ending up in the financial statements, there is a self-review threat. And so for public interest entities, it's moving towards if you do anything that might result in a self-review threat, then you shouldn't be doing it. In respect of non-PIs, there might be a bit of flexibility, but we'll have to see how it ends up. And this becomes a particular problem where in certain situations like, the SMSF space or in charities where there's no one there to take management responsibility for it. So I think there was another question about advice and recommendations type work. I mean, those can be still provided, but as long as there's someone there who can look at the options and can take management responsibility for it. So I think auditors need to be careful around this management responsibility issue and ensure that there's someone knowledgeable at their audit clients who can take that responsibility if they are providing other services.
Yeah, Joe, can I just say something too in relation to the question around partnering up? Sorry, before I said it depends on the complexity of the audits, that's wrong. Obviously, that is not a factor. I meant complexity of some of the restructured arrangements as well, because I was trying to say that sometimes it's not as simple as just saying, I've got I've partnered up with 5 different firms to do X number of funds. Sometimes if there's common ownership between some of those arrangements, or they're still considered to be part of a network firm, then they all need to be taken into account as well. And so the point really I was trying to make was, yes, if anyone out there is unsure about whether a restructured arrangement that they're looking at is going to pass the code, please send it through, and we're happy to give you something in writing in relation to that, providing we've got all the relevant, facts before us.
Thanks very much, Kelly. There seems to be some substantial number of questions coming through here around firms that have previously used the Chinese methodology and what might be a suitable suitable structure for them going forward. So I would say to all of those members that have those particular questions that there's not a one-size-fits-all approach. It would need to be based on individual circumstances, having heard Channa's response and Kelly's response. So therefore, those members are more than welcome to have those questions addressed specifically by the ATO with respect to their individual circumstances and arrangements. Kelly, there was a question in relation to transition periods for SMSF auditors with respect to these changes to the independence requirements. Could you give us a little bit more information as to how the ATO is going to address these particular requirements in a transitional type arrangement?
Yeah, sure. So because, as I said, the new guide has just come out and it's made it even clearer now that in-house audits are going to be very difficult to retain. We've given everyone this year to sort of understand these new requirements and think about, well, what does that mean for me, and think about whether they need to restructure. I appreciate everyone has got a lot going on as a result of the impacts of COVID. Everyone's been involved in probably looking at, getting stimulus measures sorted for some of their clients. So we have given everyone this year as a bit of transition year. If we need to give everyone another year, we won't be looking to make that decision just yet, but we'll look to see what happens there. But we certainly at this stage would be looking to take compliance action in relation to the 2022 audits, and the bulk of those are probably going to be performed in the 23 income year anyway, as most self-managed super funds returns are prepared by an agent and are lodged in like the 22 one will be lodged in May 2023. So we still feel that that's probably giving firms adequate time to get prepared. Happy again to hear if you don't think that is going to be enough time. In fact, when we send out our additional guidance by the end of this year, we will be seeking any feedback from clients that feel that they can't meet those particular timeframes and asking why that's the case. So yeah, at the moment that's where we're at, Joe. If it changes, we'll let everyone know.
Thanks very much, Kelly. There's been a general observation here by one of our listeners around the fact that it seems quite difficult now for firms to really conduct the accounting and audit of an SMSF. The comment was made that the hurdles to jump seem almost too high, and would our panellists agree with that? The observation's been made that it will have potentially a huge impact on our profession, which we do note. Would any of the panellists have some final observations to make in regard to that question?
Oh, I was just going to say, Joe, I think that is a very fair comment. As I said, we can't tell exactly how many firms could be engaging in in-house audits, but anecdotally I've heard there could be up to 200,000 funds affected by these sorts of arrangements. So as I said, hopefully by giving everyone a year, that is sufficient time. We'll consider whether we need to give everyone another year. But yeah, I feel that it's just going to be very difficult for firms now to engage in in-house audits, even with Chinese walls, purely because of that management responsibility that they have to overcome. As we know, a lot of trustees do hand those management decisions over to their accountant or their administrator. There's probably not too many financially literate trustees that can make those decisions for themselves.
I'd just add, sorry, Channa.
No, Doug, you go ahead.
Yeah, I understand the practical difficulties and the time that Kelly's talking about. I think it's also worthwhile remembering it's not just in the SMS for auditor space. With some of these services, it can be preparation of financial reports, or it can be other non-audit services. If one firm has to give it up, then they're going to pick up the work from another firm anyway. there shouldn't be major synergies in a firm doing the financial reporting audit, given Chinese rules. If there are synergies, then there's probably something wrong in terms of the audit process and the quality of the audit. So just encourage people to think about those aspects as well around this. I sort of understand time needed to transition to new arrangements, but there are firms that have just decided, look, we're just not going to provide both the accounting and the audit services, deals with perception problems, it's simpler, and overall it's about just moving things around within the profession.
Yeah, I would also sort of raise the issue of the management responsibility prohibition. And I mean, in fact, it's not something that is new. It's just that the restructured code makes it much more clearer. So, I mean, the principle is not that different from the 2010 version of the code. And as Kelly said, most trustees would not be able to take that responsibilities. And in the SMSF context, there are a couple of more complications because it also involves a compliance audit. And so if you're also involved in the compliance activities, that creates an additional threat if it's the same firm doing the accounting compliance and then turning around and doing the audit. And another thing is there is tax concessions for this SMSF vehicle, and there's in that sense, by giving those tax concessions, there's an element of public interest, and the independent audit needs to mean something.
Thanks very much, Channa, and thank you very much to all of our panellists for such an informative session today and for such great guidance with respect to the way independence is changing and the way the public are viewing independence and what their expectations are with respect to our profession and how we manage those obligations. So thank you very much for such an informative presentation today. We very much appreciate your time, and for those questions that we were not able to answer today, we will endeavour to have a written response to those answers prepared with a summary of the webinar. Thanks for joining us today. Siobhan, handing back to you.
Thanks.
Thank you, Josephine, and thank you to today's panel and everyone who participated. In the next 3 working days, you will receive an evaluation survey accompanied by a recording of this webinar. We really appreciate your feedback, as it is extremely valuable to the CPA Australia to help us to deliver better events to you. Thanks again, and we look forward to welcoming you to another CPA Australia webinar soon.